Good morning, everybody. Welcome to our Thursday Q&A call. We're talking about Capitec today, and we've got Pierre Mallet in the call with us, and we've got Shaun who's going to do the technicals for us, and I'm going to jump straight into it, Pierre. I think let's take it away and get started. Guys, if you've got questions afterwards, you can type them as they pop up in your minds along the way, and just type them in the chat. Otherwise, you can just switch on your mic or put your hand up, and we'll ask you a question, and we'll try and deal with as many questions as we possibly can. Thanks for joining us today, Pierre. The floor is yours.
Thanks, Sarel. Good morning, everyone. So as Sarel mentioned, we're looking at Capitec today. So we'll be focusing a bit on the first half-year results, and also then just a quick note of we changed our view on this share. So just looking at the overall executive summary, the macro environment, still the consumers remain under pressure. And then on a valuation front, we've seen the valuation multiples coming down from the peak historic levels, which was during the 2021 and 2022 years. We just, however, also mention or caution that this is a higher multiple than compared to other peer banks. So then you have to expect higher growth still going forward compared to other banks. And then in the main takeaways for us in the first half results was, first, there was a beat quite to the analyst expectations on the net transaction and commission income, because we've seen a bit of a slowdown in some of the other banks, and so people were expecting a bit lower, but Capitec had surprised on that front. And then from the start, we were always, our main focus was we were interested in to see how the credit is holding up on Capitec, and there's some early indicators of the credit quality to improve. So we had a hold recommendation based on the high valuation multiples in the history, while we won't expect the same necessarily high growth rates that we had in the history, so it didn't make sense back then. Now, due to the lower valuations and some information on the credit quality that is improving, we changed our view to a buy. So what would change our mind is if the client numbers, and especially the sales per client growth expectations doesn't play out as we expect going forward. So if we go to the next slide, thanks. The net interest income increased overall by 17%. So there was a 10% growth in the gross loans, and the other portion would have been an increase in the higher interest rates. Then the net transaction and commission income grew by 24%. That's where the beat was, also compared to the expectations. And then the headline earnings growing 9%, mainly due to that large increase in credit impairments of 62%. But this is quite in line with what we've also seen on the credit impairments expense line at other banks increasing. The operating expenses also grew at quite a high rate, but still below the revenue growth rate. So you would see the profitability ratio, such as your cost to income, improving on this front. The net loans, however, grew at 8%. So that would be some increases in the provisions there. So it's not in line with that 10% gross loan growth. And then the deposit and wholesale funding grew also 10% in line with the gross loans and advances. Okay, if we go now, we're going to just look at the more in detail on those lines that I've mentioned. So starting with the non-interest income. So potential future growth line items here would be that funeral plan and credit life income. So some of the insurance business. This due to the funeral business, that's one part where some of the industry analysts and experts, they remain quite positive on the insurance front. Otherwise, it's a competitive market out there, and they believe Capitec to be well structured in this front, and they see the banks have more information available on clients due to transactions, going through their bank accounts. Then on the transaction fee income, so the bulk of the non-interest income, we saw growing there at 21%. So they had a still 11% growth rate in the active clients, even when they have such a large client base. And then also the volume transactions grew by 18%. So even ahead of this, so the transaction activity was ahead of what people expected on this front. So this overall mainly led to the 24% increase in non-interest income that we saw there. On the expenses side, so as mentioned, the expenses were growing at a higher than inflation rate. We can see they at a total of 14%. So with most banks, salaries being your largest expense, this grew at 11%, and they mainly citing its annual increases, and then also being a mix to more expensive employees. So that would be your IT and data specialist. Then the IT line also increased at quite a large rate, although being a smaller expense line at 36%. And that's mainly due to data migration to the cloud and also improving system stability. They also mentioned that they moving away from in-house developments to more purchasing systems. And this makes sense with the type of environment where they say there's a lot of scarcity in the IT skills that companies have to compete for in South Africa. Then also with their whole growth, being growth bank and digitally led, it's also to help with the scalability of the bank and also to remain with the latest trends and technology to ensure that they're up to date on that front. The premises, the premises, this is the last one on the operating expenses. The premises cost increased 13%, and that was mainly due to some branch upgrades, including batteries. So as we see with, with load shedding going on, but we can see here this is a small expense line, and therefore, even though it's increasing at higher rates, it's not necessarily the same cost you would get at other companies, such as, let's say, retailers out there that's eating up their margins. The economic front. So the blue line is, you can see that as the debt levels of consumers. So it's actually historically quite low. A lot of people deleverage from the global financial crisis times. This mainly due to maybe people learning some lessons from that time, but also banks have increased their lending criteria. So it's a lot stricter at the moment. The red line is, however, how the debt service cost, so that's the repayments of the capital and interest on your loans. So how that is becoming a larger portion of your income, and that's mainly due to this high rate of increases that we've seen. Capitec was, however, they noted that there was a decline in retrenchments, and then also the real income growth rate that actually declined recently. That trend is improving. So basically real meaning after inflation adjustment. So the inflation is eating up a little bit less of the income on the customer side. So impairments being one of the main things that we try to look out here for in these results. So as mentioned, it increased 62%. So a main reason for that is we saw a shift from the stage 1 being your, let's say, healthy loans, them shifting to stage 2 and 3. So that's the lower quality loans. So that was the large reason here. And we also gave some figures there just to compare to, let's say, COVID times, which would have been peak levels. So the credit loss ratio is still below that 8.1 during COVID at 4.8. And the expected credit loss ratios levels so that's where how much you provide for credit. So if you have 100 Rand that you loan, you have already prepared a liability of 24.5%. So you're already taking a knock, so to say, on that. So that's at the moment 24.5%, where at COVID levels it was 28%. So it's quite still historically high, these levels. But management, they have already implemented plans to reduce the impairments. And you can see these plans already taking effect in the amount of sales decreasing. So they decreasing a bit the extent of the sales, as you can see on the left-hand bar graph. And then on the right-hand bar graph there, the percentage of new books strain is also decreasing, which they see as a very early indicator of the credit improving. And another metric that also showed improvement is on the retail loans, where they migrate to stage 2 and 3 just in the first quarter compared to the second quarter. So all of this happening in this first half that we results that we're looking at, that migration decreased 36% from 2.8 billion to 1.8 billion. So we're seeing a lot of indicators that the credit quality is improving. It's still early indicators, but it does provide a bit of comfort on this side. So our main investment case and what we worried with Capitec was, as mentioned, it was a high growth company, and it's kind of slowing this growth rate. So it didn't make sense that the valuation multiples were sitting at historic highs, and at least the valuation multiples came down now a bit. So here we can see the growth rate. So that left-hand side is a pre-provision operating profit. So just taking out the impairments, which can cause a bit of a volatility in earnings. So and then we just moved it over a 5-year, that type of growth. So it is also a little bit less volatile. So you can clearly see how that growth rate declined on that left-hand side. And then also the active clients, which they're still able to grow even at this large client base, is at 11% currently. But you can see the rate that it's growing at is slowing down a bit. And then where we think about future growth, so on the left-hand side, just looking at the net income split. So the net income includes impairments. So that's why it can be a bit volatile and skewed sometimes. But you can see the insurance space and the business bank making there up about 21% of the business. And I think it's now at least at a level where if there's future growth, it should help. And I think especially the business bank should help a lot, because as we go forward, the client numbers might not increase at very high levels, but the income per client, and that's where it will help a lot at the business bank, because they would earn more income. And then even at the previous normal retail bank, possible cross-sell opportunities within their products, and as they get more active clients to become what they call quality clients or fully banked clients, that will also improve on their total income per client. Looking at the share price performance, so we can see how it outperformed and went in the middle of that graph. You can see to these historic highs, valuation multiples, but then it came down. Would have liked to, let's say, get in maybe at the May levels there during 2023. But then remember, we were still uncertain about the credit quality, which was an overhang. So this at least provided us some comfort to change our opinion now at the moment. And then looking at the valuation, this is when I talked about that historic highs. We can see them peaking there, and now that forward PE coming down again to more attractive levels. So we have an intrinsic value currently of 2,173 at the moment, and with a buy recommendation. And that brings me to the end of my part of the slides. Thanks.
Yeah, good morning, everybody. You can see the chart there of Capitec. This is a chart I sent through this morning just after the market opened. But at this point in time, it's trading below its 200-day moving average. The long-term trend is bearish. I'm calling in the medium term, the share price is also trading below its 21-day and 40-day moving averages. It's been trading sideways in a what do you call a trading range, with the lower support around about the 1,550 level, and the upper resistance, I call it zone, is around about between 177.9 and 1811 level. You can see that resistance level there. But saying that, the share price has been testing that ascending support trend line. But this morning, it gapped lower from yesterday's close, number one. And number two, it also has broken below that support trend line. This means that could be some more downside potential. And you can see with the MACD oscillator bottom there, it's trading in oversold territory and below its trend line, its trigger line, and also confirms this bearish sentiment. So the other shorter term indicators like the RSI stochastic are also trading in oversold territory, but they're not giving any clear bullish signals yet. And as Pierre said, now we have intrinsic value of 2173, which is far above all those resistance levels. There's right at the top of the chart there. Yeah, we got a buy recommendation on it with about a 3% upside potential. But I think it would be prudent now to just wait and see if that share price will move lower or hold that support level at 1,550 level before entering a trade. But you maybe start nibbling it at these levels. Yeah, it's a difficult one at this point in time. Thanks.
Thank you, Shaun. Yes, definitely a difficult one to call. I agree with you to wait for the support at 1550. As Pierre mentioned, it looked, in hindsight now, it looks much better to have gotten in around the May levels, which was just about 1400. But yeah, certainly a stock to keep in mind. They've proved us wrong all the way. I mean, we've been forever bearish on Capitec, saying they've got bad debt and they've got this and they've got the wrong target market and the share price is too high, and it just keeps going up. And me myself, I'm living with the regret that I got Capitec at $11 and sold it at 33. It felt like Batman. And yeah, well, it's a different story. It's trading at $1,600. I've seen it over 2,000. And every time I look at Capitec, I'm thinking, why did I sell that stuff? But yeah, certainly something to keep an eye out for. 1550 level, definitely. I agree with Shaun there. And I think some good fundamental analysis by P&M. It makes sense if they increase their client numbers and if they diversify the products into those that are growing and giving them more profit. They are certainly spending a lot of money on the IT side. But I mean, they're one of the technologically more advanced banks, I think. And that's what Pierre said. It gives them the opportunity to scale properly. So definitely something to keep an eye out for. I'm going to jump into the chat now and see if there are any questions. Let's see. Nothing as yet. If anybody's got a question, just switch on your mic and just ask it outright. Let me see. Vessel says, Shaun, when can we expect the after hours webinar on the technicals? That's my bad, Vessel. I was supposed to coordinate that with Shaun. Let me see what we can put together. We'll definitely do it before the year's out. So somewhere in November, we'll definitely do a technicals webinar on a Thursday evening. Maybe in 2 or 3 weeks' time. Let's just check diaries and so on, and we'll organize that for you. I know Shaun is the technical guy for us, but I had to coordinate it, Vessel. Richard says, thanks for the prezo. There's a hand up there. Let me see whose hand's up. Please switch on your mic and go for it. Let me see. That's Stefan. Yes, Stefan.
Hi, good morning. Thank you, Pierre, for that analysis. I've got a question on the business banking part. My understanding is they bought, I think, Mercantile Bank, which is that part of the pie, so to say. My question is, what market segment in the business banking do they focus on? And what is the total pie sort of, and what is the market share? So how much growth do we expect in the longer run? I see you only project up to like 2024, but what's the longer range? Are they aiming to overtake the standard banks and the ABSAs in that segment, or are they aiming for a different market? Thanks. You're on mute.
Thanks.
Yeah.
Hi, Stefan. Thanks. Yeah, so I'm expecting this to be. So I'm not sure yet with your question how it's going to play out with market share. How much are they actually going to take over at the end? I think it's going to be a bit more difficult in this front compared to what we saw with the retail clients, what they achieved. And I think they kind of in that space, they almost, if you think about, almost created their own market, you know, for like a lower income type of market or lower cost banking, which they almost started in that front. So I think it's going to be played out a bit less. I don't think it's going to be as large a market share that they're going to take over in this space. And I would think in my mind it would be more to your commercial side, so not your corporate, institutional, large banking client. I would think it's going to be more in that space where they'll it will be easier to go into on that front. They're very easy to set up, the business profiles and all of that, and how they are positioned. I would just think it's more into your smaller type of business space, if that answers it.
Thanks, Pierre. I think that does. I think they're playing in a slightly different market than the rest of the banks, and I don't think they're trying to compete for the market share of the standard banks in the first range in the corporate sector specifically, because of their typical banking client profile and the business stuff that they're doing is, look, there's lots of small businesses and lots of medium enterprises that are looking for finance and not turning to traditional banks for that, because they typically try to ring fence you in there through utilization of all their products, and some of these smaller business owners don't like that. So I think they are playing in a different sector, slightly different sector, but still very profitable for them. Okay, let's see, go back to the chat there. There are no other questions, guys. If there are no other questions, it's 8 minutes to 12. Then we can close this meeting, guys. Oh yeah, wait, an impressive presentation. But my problem is that since last Friday, PSG, I'll sort that out for you. Who's that? Please pop me a mail at sarel.snyman@psg.co.za, and we'll sort that out for you quickly. It's just we had to do a password reset across all our platforms for security's sake. As you can appreciate, the financial institutions are being battered with all these hacking attempts and stuff, and we're trying to keep the environment as secure as we possibly can to protect you, our clients. I know it's uncomfortable if you're struggling to reset the password, but it's definitely temporary, and we'll fix it in a jiffy. Will you be covering the messiness at Renegen anytime soon? I think we have got Renegen coming up, although I think next week, I cannot for the life of me now remember what's next week, but I did see Renegen somewhere. Keep an eye out, guys. What I will do next week is I'll share the calendar going forward. We'll add it to the presentation, because this question seems to come up every week anyway, so that we can show you what's coming up in the weeks to follow. We have got that calendar 2-3 months out, so we'll do that for you, and we'll stick that up there, and then hopefully we can tell you, Stefan, when we're going to be talking about Renegen again. Tabogo says thanks. Pierre, there are no further questions. Thank you everybody for attending. Thank you for spending time with us. Thank you for asking questions, Stefan and them. And we look forward to hosting you next week. Thanks very much. Have a fantastic Thursday. Cheers.